Hello, dividend growth stock investors. It's Colby, the DGI Crab, coming to you on a Friday. Happy Friday, into the work week for some of you, or maybe just the beginning for those of you that are side hustling, working hard on the weekends, and coming up with extra income so you could put it into the stock market and generate passive dividend income that you can one day retire off of and live very comfortably without having to worry about stocks going up and down and all of that, because this channel just focuses on 60 high quality dividend growth stocks with long track records of increasing those dividends and not subjecting their shareholders to the dreaded dividend cuts. So every Friday, if you're new here, we go through each of the four tiers. I've broken these stocks down into four categories or tiers, and they are based on the age of the investor. So let's talk about what this Friday video looks like, you guys, just for those of you who are new. The way that I go about doing this, and this is not professional financial advice, so you can make your own strategy. I'm just sharing my personal strategy, what I do, and what I believe is the best method for me to going about investing in the market and acquiring the passive income. So 50% of my investments go into ETFs, which also should be acquired based on your age and time horizon. I'm only purchasing stocks when they are yielding 30% or more above their 4-year average, the exception being my top 10 favorite stocks. So my favorite 10 of the 60, if they hit the 20% above average yield, above 4-year average yield, I will go ahead and start adding them then, because it's fairly rare for any of these particular 10, which you'll see in a minute, to go very far above that 20%. I think it's a good idea to do age-based investing pretty strictly. You should probably remain in your tier unless there is a stock in a different tier that's yielding at least 50% or more above that 4 average yield. And finally, if this manageable list of stocks for your age category, if we don't have anything that looks like it's in that buy zone, then at that point, my strategy is I'm just adding more to ETFs. I'll just get that automatic diversification, and ETFs, in my opinion, are the thing to dollar cost average into, meaning you just buy them every so often, regardless of what the market conditions look like. I think that timing the market on ETFs is probably not a good play. But we do want to try to time the individual stocks more, because there is more inherent risk with single stocks. So let's jump on in, guys, to the spreadsheet where we've got each of the four tiers. So tier 1 is intended for the investor aged 18 to 30. The goal with these types of dividend stocks is you're usually getting a yield in the 1%, 1.5% range, not acquiring yield very quickly. But cumulatively, the stock should average dividend annual increases of 12% at least, maybe more. So the idea here is to acquire compounders that are going to really snowball a lot over time, even though that starting yield may not be the highest. So for tier 1, Nike is still undervalued based on my projections, you guys. Now, you're probably sick of me telling you every single week that Nike's undervalued. We've seen it go all the way down into the low 70s. Seeing a price recovery here all the way up to just shy of $90 kind of makes it seem like, okay, probably time to pump the brakes on Nike a little bit. I'm going to keep going, because I thought a few months ago before the epic crash, I thought like $92, $93 a share on Nike looked like a pretty good deal. And then the stock has just gone through a tough last few months, as I'm sure a lot of you are aware. All you have to do is look at the chart over the last year to see the drop. But if you look back a couple, 3 years on Nike, at one point these shares were above $150. Now, at that point, I think you could certainly say, well, those were very overvalued shares. And again, based on my metrics from looking at that 4-year average yield, when Nike was $150 a share, it was not a good deal. It was very much overvalued, and I wasn't even touching it. But, stocks, sometimes when they have a major drop like that, it takes them a while to recover. You've got an opportunity here to continue to build your position in Nike, because When it recovers at some point in time, I don't know when that's going to be, but at some point, I would imagine they'll have some headwinds and things will be looking up. Their stock will get overpriced. And, and at that point, maybe it stays overpriced for a year or 2 years. And you're sitting there thinking, wow, I bought up a lot of that at a much better deal. And now I'm just sitting and reinvesting dividends. By the way, I don't sell stocks at this stage of my career. I just hold on to them and let all of them reinvest their dividends back within themselves. I don't try to time my dividend reinvestment or target that. I just let the dividends continue to expand my position out. Okay, guys, so tier 2, this one has the most stocks in it. It's my personal tier. And tier 2 and tier 3 are fairly close together. You could make the argument that tier 2 and tier 3 could be one giant tier, but I like to keep a fairly manageable list of stocks that I'm actively putting money into. Don't want to necessarily have to track 200-300 stocks, looking for deals, taking some chances. If I've got somewhere between 10 or in this case 19 to keep track of, very, very manageable for an individual investor. Now for the 31 to 40-year-old, we want a yield more above 2% starting out. Maybe we can get yield up in the 3% range, but ideally what we're trying to get is that 2 to 3% yield with maybe about an 8, 9, maybe even some years 10% annual dividend growth rate, but certainly in the high single digits. For my tier 2 folks out there, we've just got Hershey. It sits alone now in the category. At one point, just a couple of months ago, we had like 5 stocks that were sitting in this green of 30% undervalued or better, and that has just dwindled down all the way now to where Hershey just sits alone. And Hershey was another one of these. I waited a long time on Hershey before I ever owned any of it. It just seemed like it would never become undervalued enough for me to want to touch it. I mean, I think I sat and watched Hershey stock for, it had to have been almost 3 years. It had been on my wish list of stocks, and sticking to my metrics, I knew that it was overpriced based on all of that. So I just kind of waited and really felt like I missed the boat entirely on Hershey, and that I'd squandered away several years where I could have been building up this nice position, and then I just didn't because I was being too stingy looking for deals. And I mean, now this has been the primary stock I've been adding for the last few months, really starting to get a decent little chunk of Hershey built up. I'm very excited about it, and just seasonally it's down, but I'm certainly not worried about it long term. Not worried about any of these, you guys. Next up, Hormel and Archer Daniels Midland continue to be at the top of the list here for our tier 3 folks, aged 42 to 53. This particular category, we really want to start out at the 3% yield, minimum in most cases, and hopefully we can even get some things in the high 3s, low 4s, depending on what kind of stuff is on sale. We still want to get at least a 5% annual dividend growth year to year, hopefully more like 6 or 7 on some better years. But this is good, stable group of stocks, very, very steady. A lot of popular names here like Pepsi and Johnson & Johnson and all of that. But Hormel and ADM, just been down years for both of these companies. I think they're both in a really good spot right now to just keep adding on and enjoying the yields in the mid 3s. Archer Daniels Midland, I almost put this one on tier 2 because I thought that the 5-year growth rate might be more in line with people younger than 42 to 53, but ultimately they ended up kind of falling here. Tier 2 already has the most stocks in it. And I'd be excited about adding this one in my 40s for sure. Tier 4 are 54 and up investors. You guys need to be acquiring, pretty good high starting yield right off the bat at this stage in your life. We want to try to get 5-6% yield on our individual stocks. In some cases, you're going to get more than that depending on what company or industry we're in. Not totally sacrificing dividend growth year over year, you guys. We still want to try to target about a 3% dividend growth rate even at this point, so that way we can keep up with inflation when you're not reinvesting your dividends anymore. With this group of 10 stocks, These are 10 of the very best of the higher yielding, in some cases less tax advantage, like our REITs or our BDCs. But it's been a while now that we haven't gotten anything that looks like a great deal in this high yield category. I can't imagine that the rate cuts are going to help in any case with this, but I don't know. When I don't have anything in my tier that looks like it's a good deal, I think it's a great time to just keep piling money into the ETFs. Why not? Might not be super exciting. You might not feel like you're getting some great deal or anything like that. But hey, it's all about consistency and diversification and not overspending on something, especially something that's as inherently risky as an individual company stock as opposed to an ETF. Again, real quick, y'all, if you're new, these are just my 10 favorite stocks. If I whittled my stock portfolio down and made myself only have 10, I'm going to hold on to these. These 10 are located somewhere between tiers 1 through 3. It's not a new group of stocks. It's just my 10 favorite. Any of these hit that 20% undervalued mark, I go ahead and buy them. And for me, I think that they're so great. I think any tier could honestly buy them. There's nothing wrong with adding to your position on any of these. Pepsi is getting close to that mark now at 16% undervalued, right at $170 a share. So really, we just need that to fall just a little bit more. If I could get Pepsi more like around 167-ish, 166.50, somewhere in there. Feeling really good about that, but I'm holding out on you there, Pepsi. You got to do me a little bit better than 170 even. So the strategy for the week, based on the tier, would look something like this. So I like to do a ETF allocation. Tier 1, 25% into the S&P 500, 15% small cap, 5% into a dividend growth, and 5% into an international. You could swap out an ETF of a similar style that you might like better, but these are the ones that I like and the ones that I invest in. Tier 2, I flip-flop them a little bit here. 25% dividend growth, 15 S&P, 5 small cap, 5 international. Tier 3, we go 45% dividend yield ETF, of which VYM, SCHD, and DHS are my top 3. When I hit age 42, I'm probably just going to split it up evenly between these 3. They're all very different in strategy, all very solid. And then for the tier 4, you've got your top 80 yielding stocks in the S&P 500 for SPYD. I like that one quite a bit for this particular age tier. And then you've got some alternates here like high yield bonds, preferred shares, MLPs, my 3 favorite covered call ETFs, Devo, JEPI, and SPYI, and then international. Breakdown would be as follows, tier 1, I'm just going to throw my 50% allocation all into Nike, just load up on it, get it while the getting's good. Hershey, I'm going to do most of it into Hershey, 45%, but because Nike's still at that 50% or more undervalued, I'm going to throw a little fiver at that one, just a little bit to keep building that position up. Hormel and ADM is the top 2 here, 25 and 20. Hormel's got a slight edge this week. These guys have been kind of going back and forth, but we're going to stick to Hormel here. I'm even dipping my 5% here again, even in tier 3 down into Nike. Might as well. It's going to give me better dividend growth than most of the stuff in tier 3, at least it's projected to. And then for tier 4, no deals, you guys. So keep up with the ETF double down if I'm in your shoes. Everything except for the international, I personally keep that at just 5%. I'll throw that extra little 5 left over into SPYD. So the percentage breakdown for me in this category for the week could be 35 SPYD and then 10, 10, 10, 10, 10, all the way down here to still 5% in the international. And this collectively is going to give you a really nice dividend yield. You've got a monthly payer, 3 more monthly payers, lots of monthly income there. So, hey, don't be down if you don't have a good deal yet, tier 4, because these are some pretty solid options here. That's the video, guys. Links in the description below to an explanation on each of the 4 tiers. And send me your questions at dgicrab@yahoo.com, and I'll catch you next week.